In 2018, Elon Musk tweeted, "I will pay over $11 billion in taxes this year." Sounds like a lot, right? But that only happened because he chose to sell his Tesla stock. In most years, Elon, one of the richest men on Earth, pays next to nothing in income taxes. How is that even legal? Let's start with the basics. When you make money, the government wants a slice. That slice is called taxes. But not all money is taxed the same way. There are several types of taxes. The main ones are income tax, which is what you pay on your salary or wages. Capital gains tax is what you pay when investments make you money. Corporate tax is what businesses pay on their profits. Property tax is the tax on your real estate. And finally, sales tax is what's added every time you buy something. Now here's where it gets interesting. The average person earns active income like a salary. That gets taxed at different rates based on the country. Rich people don't typically earn most of their money through a paycheck. Jeff Bezos' salary at Amazon was around $81,000 per year. But his net worth came from owning Amazon stock, which soared in value as the company grew. And stocks are not taxed until you sell them. Even then, gains are taxed at the capital gains tax rate, which is lower than income tax, which could be anywhere between 0 to 20%. So holding wealth in stocks means no taxes while it grows. Again, many billionaires don't sell their stock. They borrow against it. Now consider this. Let's say a billionaire wants to sell $40 million worth of stocks. If you pay 20% capital gains tax on it, that's still $8 million gone in taxes. So what do they do instead? They borrow $40 million by keeping their stock as collateral. Banks give them loans with super low interest rates because the stocks act as collateral. Sometimes this could be as little as 1 to 3% interest rate. At this rate, they're just paying $800,000 as annual interest against the $8 million they would have had to pay if they just sold their stock. Loans are not considered income, so no tax is triggered. Even if the value of the stock increases, there's still no capital gains tax because it hasn't been sold. So they get to use cash to make new investments without selling any assets. Now you may be wondering, what about corporate tax? Shockingly, corporate tax is one of the biggest areas where giant companies legally pay little or nothing in taxes. So, what exactly is going on? Imagine you could reduce your taxes this year, not by earning less or cheating the system, but just by changing the date on a bill. Sounds small? Big businesses use this trick to save millions. And yes, it's totally legal. It's called the all events test. Let's say a company expects $2 million in income and $1.2 million in expenses this year. That leaves $800,000 in taxable income. At a 21% corporate tax rate, that's $168,000 in taxes. But now watch this. In December, the company received a $400,000 bill from a vendor. The service will be delivered next year, but the contract is signed and an invoice issued now. Under the all events test, they can deduct that now. So now the company's expenses are $1.6 million, and the taxable income is $400,000, and the tax owed is $84,000. That's a legal tax deferral of $84,000, just from timing. Now scale that up. Big corporations manage hundreds of contracts, invoices, and recurring costs. They prepay expenses when it benefits them, delay income when possible, and schedule everything based on tax year end, not the calendar. In some cases, this lets companies cut their tax bill nearly in half, just by shifting numbers across a December-January line. And this is why corporations have entire tax departments that do nothing else all year. Another clever way corporations make use of this is while giving executive bonuses or company-wide incentive pools. Let's say it's December 2024. A large company has had a great year and wants to pay out bonuses totaling $5 million, but it won't determine who gets how much until March 2025. If the compensation committee meets before year-end and formally commits to paying $5 million as bonuses, and that money will be distributed to a fixed group of employees, then the company can deduct the full $5 million from 2024's taxable income, even though no one gets paid until 2025. Let's say the company has $50 million in taxable profit. A $5 million deduction reduces it to $45 million. At a 21% corporate tax rate, that's a $1.05 million tax savings. And here comes the most loved trick by all. Companies have moved billions of dollars in profits to low-tax countries like Ireland, Luxembourg, or Bermuda. It's called profit shifting, where they make money in one country, but report it in another country with lower taxes. So let's understand how this works. Let's say a wealthy individual sets up a shell company or trust in a tax haven like the British Virgin Islands, Cayman Islands, or Panama. This company doesn't do much business. It just holds assets, like cash, yachts, property, or even investments. The shell company then opens a bank account in a tax haven with strict privacy laws. The account is under the company's name, not the individual's. The individual transfers money or assets into that account. Now, that money sits in a jurisdiction with no or low tax, and now they can use money from that account. The key advantage here is that many tax havens don't report account details to foreign tax authorities. The IMF estimates that tax havens cost governments over $600 billion every year. That's money that could go to healthcare, education, or infrastructure. So, even though this is known, why is it still legal? Tax havens remain legal largely due to the complexity of international tax laws and the fact that countries have sovereign control over their own tax systems. There's no single global tax authority. This means that what might be considered unethical tax behavior in one country may be entirely legal in another. In fact, many small countries depend economically on being tax havens. These tax havens often intentionally design their laws to attract foreign money by offering secrecy, low tax rates, and limited regulation. They benefit economically from the influx of wealth and business registrations. Even though tax authorities may suspect that a shell company isn't really a company actually making money, proving it and taking action is incredibly difficult. Tax havens often have strict bank and corporate secrecy laws. That means they don't require companies to disclose the real owner of the company, nor do they share financial data with foreign governments unless forced by international pressure. And even then, only under specific conditions. Rich individuals or corporations often create layers of entities across different jurisdictions. For example, a trust in Panama owns a company in the Netherlands, which owns a subsidiary in Luxembourg, which holds assets in Switzerland. Each jurisdiction adds a layer of legal and investigative complexity. Sounds confusing, doesn't it? Let's break it down. Let's say Sarah is a tech billionaire. She wants to protect her $100 million and avoid paying a big chunk in taxes. She creates a money maze using 4 countries. Sarah starts by creating a trust in Panama. A trust is a legal entity where one party, that is the trustee, holds and manages assets for another, that is the beneficiary. Now, the trust technically owns the assets, not Sarah. Panama doesn't ask who really owns the trust and doesn't tax foreign income. Now, the Panama Trust opens a company in the Netherlands. The Dutch company acts like a middleman for moving money. The Netherlands has deals with many countries, so tax on money transfers is very low, and it has a huge network of double tax treaties. This means that any tax paid in the country of residence will not be taxed in the country it arrives at. Then this Dutch company sets up a smaller company in Luxembourg. This Luxembourg company says it owns patents or intellectual property. Sarah transfers her $100 million into this company as payment for using her tech idea. Profits earned by licensing, IP, royalties, or interest income are taxed at very low effective rates, sometimes close to zero. The Luxembourg company now sends the money to a Swiss bank account. These can include stocks, bonds, and cash. That account is under the company's name, not Sarah's. Switzerland is famous for keeping things private. So now Sarah's wealth is sitting safely in a Swiss bank. But now you're probably wondering, how do these countries make profit if they're not charging any tax? While they don't charge high taxes, they charge a ton of fees for setting up companies, trusts, and accounts. Now, this amount may not be a big deal for the rich, but if you multiply that by tens of thousands of companies, and that's a huge industry. These countries become mini financial hubs, full of lawyers, accountants, consultants, and bankers, creating a growing local economy. These countries attract billions in deposits, and that capital can be reinvested, loaned, or used by banks to grow. So in short, these countries don't rely on taxes the way most do. While most of us are trying to save a few bucks on groceries, the ultra-rich are busy rerouting millions through tropical islands. All legally. Wild, right? If you found this video eye-opening, hit that like button. And don't forget to subscribe and step into the side of economics they don't teach in school.